Hey everybody, I'm going to be walking through the Jones Law practice set that we have to work on in our class this semester. And I know I've spoken on this a little bit in class, but to give you a reminder of what this is, it's a kind of a comprehensive sort of, real world type project that will have us moving through a whole number of different activities in the accounting cycle and coming up with a set of financial statements, doing closing entries, doing a bank reconciliation, working in the general ledger and the general journal, so on and so forth. So hopefully this walkthrough will help you complete the project and not spin your wheels. I am going to have this template on the Canvas, so you can go directly into that. And I would greatly prefer that you complete this project in Excel. I think for your benefit as well as mine, and just not even so much for my benefit, but more so just to get you the experience in using Excel. And note that if you see, I will try to explain slowly any formulas that I'm doing in Excel here as I'm going through the project. But if you see me do anything that is, or you see me do something in Excel and I don't explain it well enough, or you're still confused after my explanation, definitely reach out and just shoot me an email or message or ask in class what exactly it was that I did, because Excel skills are hugely important, and not only in accounting but just in business in general, but especially in accounting. So I really would love you guys to get some experience in Excel doing formulas, and hopefully this project will do that and you just kind of follow along and see how it all comes together. So, okay, without further ado, let's jump into the project. Okay, so here we are on one of the tabs in the workbook here. So you can see there's a beginning, trial balance, and subledgers, checklist, COA or chart of accounts, memos, so on and so forth. And so we'll be working through all these tabs as we progress through the project here. So here is kind of the overall instructions or explanation for the project. So we'll look at that real quick here. So what it says is on February 9th, you assumed the job of bookkeeper for this fictitious company, Jones Law Company. The previous bookkeeper quit without notice on January 31st and burned the accounting records on the way out the door. So that's a bummer, but you're here. You've got some clues. You've got some information to start working off of. And yeah, let's work through it. So the company's year end was on January 31st. John Jones, the owner of the Jones Law Company, kept a copy of the chart of accounts, the post-closing trial balance for January 31st, and the schedules of accounts receivable and accounts payable, which are shown below. So we can see here, we've got these subledgers of AP. So remember, accounts payable, these are balances due. And this is all as of January 31st. And just what I was saying there is that we're assuming, this problem has this case study, I guess, if you will. It has the prior bookkeeper leaving exactly at January 31st. You come in, and you're going to be doing the accounting in February. But we need our beginning balances, as we were setting things up. And so what we have available, luckily, that they didn't burn on their way out, was the closed trial balance for the end of January. So you've got beginning balances for February, in other words, right? The ending of January is the beginning of February. So you've got that, and then we've also got these schedules that show your accounts payable balances. So who does Jones Law owe money to, right? Accounts payable, amounts that are due to be paid. We incurred those expenses in January or previously, but we still haven't made the cash payments on those, right? So that still shows as a payable balance totaling to $47.50, which you can see here that will sum, this is in our beginning balance on the trial balance or in the general ledger, et cetera. Those numbers tie out there. You can see that. And then we also have a receivables balance. So remember, receivables, cash that will be received. This revenue was already earned in January or previous or period before January, and it's just the cash has not yet been received from those customers. So, and then you can see again that the 1450 ties up into our 1450 here in our closed trial balance. So in other words, if you were to drill down into this number, this is the detail that supports what those balances are made up of. So it's AR, accounts receivable, but it's one number as a total, but it's not just one, customer who owes us money. And then our payables, it's not just one vendor that we owe money to, but a whole collection, that's how AR and AP would typically represent. Okay, so that's kind of our starting point and an explanation of the project and where we're beginning. And then the second part of the instructions notes that so the owner wrote memos for all transactions that occurred during or occurred between February 1st and February 9th when you started on as the bookkeeper in this case study. And then starting on the 9th, he puts all the invoices in your box, as well as copies of any checks he writes, memos of instruction. And so for February, we're going to record the transactions in the general journal, post them to the general ledger accounts, and using accounts payable, et cetera, so on. Just all the things that we've learned, but kind of putting this into practice in more of a realistic, kind of holistic problem that has a lot of different pieces to it, so we can get a little bit of more real world type experience. All right, so from there we can see, and so we noted here there's memos written. So we've got a whole page of memos here. So this is, and let's see how many in total. We've got 18 different memo type transactions to record. And then we have this, I guess the final memo, if you will, talks about preparation of a bank reconciliation, and then adjusting entry information that we'll need to do some depreciation calculations and some different types of adjusting entries like we've been looking at in class. So one thing to note too, so you can kind of see, on the 9th, you came into the position, right, is our assumption here. And so you can see some of the notes and things, these are kind of like a simulated invoice or a bill from a provider, from a vendor. And then if we look back towards the beginning of the month, before you were on, this is kind of his explanations from the owner, if you will, before you were employed, just telling you what he did. And, he didn't do any of the accounting yet. So that's our job, is to come in, kind of make sense of all the accounting that happened during the month, and produce a finalized set of financial statements for February, have all the accounting recorded in the general ledger, and we've got our journal entries all recorded as well, and close the books essentially. And we don't necessarily do that in this problem. We're just focusing on February, but the thing that hopefully you kind of see out of this whole project is the continuation of the accounting each month, and how, when we're done with our closing entries, that will roll on into March, for example, and you basically do the same thing, just going forward forever. Kind of, that's a basic bookkeeping essentially. So, and you'll be able, we've kind of, he's already seen, we're starting from January, so we're going to have beginning balances and information from before February, and we're going to see how working in February that information is necessary, and this whole life cycle of the accounting process on a month-to-month basis. So, okay, so that's our memos. So this is kind of those source documents, if you will, that we're going to post entries off of. We have a bank statement here that we've been provided that will show us our beginning balance at February, and then the ending balance in February, and all of the transactions that happened in the bank over that time period. some nomenclatures like service charges that the bank charged us. We've got interest revenue that we earned from the bank. We've got electronic funds transfer. So in this instance, like a receipt from a customer of an incoming receipt that was not a check, basically. So we'll look at this in detail when we get to that part of the problem. But yeah, this is Butte Community Bank. Comes in the mail at the end of the month, and you as the bookkeeper look at this and compare that to your accounting records and make sure that the reconciliation, the amounts in the general ledger, reconcile to the bank statement, and generally agree, and that will show us that everything's been captured correctly in the accounting records. Here we've got some of the templates that we'll be working directly into. So we have a general journal, so you can see a location to put each journal entry into. And we've got bank reconciliation entries section, and then a section in the journal for adjusting entries. And we're gonna do work in there. So a lot of this is kind of the source. This is what we're working off of, these tabs that we were just looking at, and then the following this one, and then the following tabs we'll look at real quick here is where we're gonna do our work essentially. So and we've got a general journal, so you can see all the different types of accounts in our general journal. So we've got all of the things. I apologize, my computer is being funky. Okay, so we've got all of the the ledgers for the different accounts. So you can see, capital, draws, expenses, revenues, et cetera, et cetera. We've got a place to do our bank reconciliation here. And then we've got a worksheet to do our adjustments. So we'll go from our unadjusted trial balance, post our adjustments, and end up with an adjusted trial balance. And then we will also have a finalized adjusted breakout of the balance sheet and the income statement accounts. And then we will also have once we're basically done with all that work and we've done everything, we've got our balances adjusted and trial balances prepared, we'll have this nicely put together trial balance that then we can take that information and bring it to our financial statements here. So we've got an income statement, statement of owner's equity, and our balance sheet. And then after we've finished all of that, typo there, we've finished all of the work preparing the financial statements, we'll post a closing journal entry, and finally we will create our post-close trial balance, or a closed trial balance. And that, just like we kind of began the conversation with in this project, you can see here's the post-close trial balance for January, and then that's what our beginning balances are, and we're going to have a closed trial balance for February. And then, like I said, we're not going to do anything in March, but theoretically that's kind of, you finish this, now you've got your beginning balances going forward, and the whole process kind of starts over again, more or less, right? Okay. So with that, let's take one additional thing to mention is that we have a checklist here that we can look at. So this is kind of a nice, just a prepared listing of tasks to guide us, from a student perspective, just to kind of orient ourselves. I'm making this video so you guys can just follow along. So but even for myself, having a checklist, it is nice to have kind of a structure to keep you on track. So kind of all the things we just talked about: analyzing the memos, writing the account numbers on the general ledger, use chart accounts, posting beginning balances, posting all the transactions, bank recs, complete the unadjusted trial balance. Historically, this has been kind of a two-part project with a preliminary submission and then a final submission. I think in our class this semester, I'm just going to have one final submission to give you guys a little more time, because I want you to really focus on the Excel part of it. So I think number 7 will be a little bit different. But then, so we complete the unadjusted trial balance. Then we're going to do the adjusting entries. We're going to post those to the trial balance worksheet, finish the trial balance worksheet, not the trail balance, the trial balance worksheet, balancing all columns. Then we're going to prepare our income statement and all that, closing entry, post-close trial balance, and then turn it in. Yeah. And so that is the process of kind of how we're going to follow through the whole project. So, without further ado, hopefully that gets you oriented, and let's begin looking at our memos and analyzing the transactions to write our general journal entries. Alrighty, so we are on kind of step 1 here, basically, of the project, the Jones Law project. And so as it mentions here on our checklist, we're going to analyze the transactions on memos 1 to 18 and write the journal entries for those. So here you can see all of the memos. They're numbered and all that kind of stuff. And so we're going to look at basically the first 18, and then we have some extra information down here for adjusting entries, etc. Well, let's start just with our general, just kind of ongoing accounting activity, as opposed to some of the adjusting entries, etc. Okay, so here's our memos, like I said. Then we've got our journal here, and we've got our general ledger here. So we're going to look at our, I think in our checklist too, let's kind of break this out. So we're going to look at our transactions, write the general journal entries, and then we're going to post, we're going to set up our general ledger here with account numbers, post beginning balances, but then we're going to post those transactions from the journal to the general ledger and kind of go through this whole, accounting cycle, and give you guys kind of a feel for the whole process. So let's begin. All right. So memo number 1, again, remember we started in this case study, the ideas that we started on the 9th of February. So the first 9 or through the 9th, these are kind of memos from the owner. And then when we get down to here, we start seeing like actual invoices and things like that to record. So anyway, okay. So the first memo says that we issued check number 5347 to Dell Computer in the amount of $4,500 to purchase a new computer and printer. And so we need to book a journal entry to record the purchase of this computer and printer. And one thing we want to do is use our chart of accounts to see which accounts are available to us, where we might want to put, book those items essentially. So all of our asset accounts are in the 100 series. And we can see we have cash, AR, prepaid, insurance, office supplies, office equipment, and office furniture. And the one that probably captures this the best said it was a computer and a printer would be office equipment. So we're going to use that at those accounts. And it was on February 1st. So the date there. We're going to put office equipment for $4,500, and we paid with a check. And I think I've mentioned this in class, or maybe that goes without saying, but the issuance of a check is essentially recorded as a cash transaction from an accounting perspective. So I know we've been maybe saying in class, paid cash, that's relatively, the typical payment cycle for a business is to use checks, and checks basically being cash equivalents, more or less. So anyway, so something to note that actually I'm not sure if I talked about before. So okay, so we're debiting our office equipment to increase that asset, and we're reducing our cash to decrease that asset. So again, just kind of exchanging one asset for another, if you will. Okay, so that was the first transaction we needed to record. Number two, on the 2nd of February, we issued this check in the amount of $840 to our insurance agency for the next 12 months of prepaid liability insurance. So $840 paid to basically purchase 12 months of prepaid insurance. And so we're going to want to go to our journal. And we can look too, I think I saw that already. So prepaid insurance. And I'm going to copy that. This will save us a little bit of time. And then I'm going to come here, excuse me, and hit click paste. And that will just put the, excuse me, that will put the amount there. Do my little format painter, and it just, makes it a little easier. But we paid that with a check. So again, it's cash. Yep. And that's 12 months of prepaid insurance. So let's put our date in here. Okay, let's go look at memo number 3. We received payment of $5,500 from Iacocca Motors for work we performed in January. See AR listing. So this is kind of getting back to our AR balances here. And so, okay, we can see Iacocca Motors was a component of that $14,000 that was owed to us, $14,050. And the memo said we received the full payment. So that's what they owed us, $5,500. So that is a full collection of payment from that customer. And that was on the 3rd. And so we're going to record an increase in cash. Oh, I didn't put my number there. The last one. 840. Yeah. So, and then on that one again, remember we're purchasing prepaid insurance. This is gonna be turn into expense every month as it's the turn that 12 months passes. But the initial purchase transaction is just to increase the one asset. Similar thing. We're booking in one asset and reducing cash, reducing another asset. This is a receipt of cash on this date for $5,500. And remember that if we had earned this in February, in the current accounting period that we're looking at, we would be recording revenue as our credit entry. But note that a couple things. The fact that this is on our AR balance, our AR schedule here, indicates that this was previously recorded. The revenue was previously recorded, when it was earned in a prior period. So we're not going to credit revenue in this instance because we already recorded that revenue, like I said, in the prior period. But instead, we're going to reduce our accounts receivable to clear that out because, it's been received. It shouldn't be, a receivable anymore. And so we're going to credit our accounts receivable. And this is just a little Excel trick while you guys are going through. You see how this lines up just on each other. There's a couple tricks you can do. You can click this kind of alignment tab over. See that moves it over. And I think we've seen this. The credit I've showed, you've seen this on like a whiteboard when I'm writing this out, is that the credits are indented. But one little trick you guys can do, and something that I use a lot in Excel, is if you have if you want this to look like this, because this is already indented or has certain formatting, you can use this format painter tool. So you just click that, it'll take whatever in that cell, and then you can just click on the cell you want to look like. And it's just kind of a nice way to do the formatting really easily if you want to copy and paste formatting, basically. So, okay. So now we've received cash. We cleared out that accounts receivable. And then we're going to go here to number 4. We purchased $1,360 of office supplies on account from Office Max. So a couple things here. We've got office supplies, and I think that was one of the, office supplies. And what was the date there? Was that the 4th? Yeah, it was 4th. So we're increasing our office supplies asset by $1,360. And so this one indicates that it was purchased on the Office Max account. So it's not, we didn't pay for it yet with a check, essentially. So it's not going to be a credit to cash in this instance like we've been seeing, but instead we're going to be increasing our liability for that purchase. So again, remember, payable, we're going to have to pay that in the future. We owe it to Office Max or whatever I said. Office Max. And that will increase. And we're not necessarily going to update the AP schedule per se. That's not really specifically part of the assignment here. But if we were updating these, for the transactions that are happening in February, we would have cleared that one out because we received the payment, and then we would add to the AP balance of we'd add a new line in the AP schedule for Office Max and 1,360. So just something to keep in mind, but we're not necessarily we're not going to do that in this assignment specifically. Okay, on the 6th here, we issued this check in the amount of $1,800 to Rodriguez Property Management for February rent. So we're paying for rent for this month again. So it's not prepaid rent. This is the rent that's associated with February. And so if we're going to do rent expense. Remember, if we were prepaying rent, just like with prepaid insurance, we would be booking that in as an asset. And the total was $1,800. So cash goes down, expense goes up. Okay, number 6, we received and deposited checks from Sega and Microsoft for work we performed in January. And let's see, so again, these were previous previously earned revenue that we were owed money from doing this work. And was that the full balances? Yep, looks like we received the full balances. So we can do this. Basically, it's going to be that same entry. So we have cash and we have accounts receivable. And it's going to be for both of those amounts of $1,500 plus $2,200. So I'll do a little formula here. So you can push the equal button and say $1,500 plus $2,200. And that gives you the total that we received. And then you can copy. You can right click and copy, and you can paste that in. It's just some of the little Excel functions to look at while we're doing this. And that was on the 6th as well. Okay, number 7, we have legal services that were provided for the following clients. We've got Whitmire, Ford, S&S Produce, Butte College, Mooney Farms, and none of the clients have paid us yet. Okay, so let's do the same thing. So 9,300, 5,000, 4,600. So we've done the work, and again, so this is work that we did in February, but has not yet been received. So we are, and actually let's take a quick look at the chart accounts. What do we call legal revenue? Okay, so let's make sure we use the right account name. And this is on the 9th. That's what it said. Yep. Okay, and then we had all this was different work performed. So 9,300, 5,000. Again, I'm gonna just add these all together. And 93, 5,000, 4,600, and 2,100. So we can go back here. You can see the formula up in this formula bar, and you can continue to add to this formula. But I already forgot what I was supposed to be adding back. Okay, so 4,600 and 2,100. 46 and 2,100. Okay, so we get 21,000. And here's a little trick too. So if you want to just copy that same amount essentially, or whatever's in that formula, you can do an equals, and then you can either click on that cell, or I pushed just the arrow buttons to navigate over, but you could just do equals, take your mouse and click on that cell, and it will basically just give you the same thing in both cells there. And remember, so yeah, just a couple little notes there. We earned the revenue in this period, so it's legal revenue, recorded now, and then we're recording an accounts receivable for that because they have not yet paid us. Okay, so that's good. Okay, number 8. Let's see here. We've got printer repair services on the 12th. And so here, just to make a quick note of this is kind of in the problem. It says we started on the 9th. So now we're seeing not just a memo from the owner, we're seeing like, this is kind of representing, you open the mail and, oh, here's your, here's your statement. And you owe us, $458 for some work that this computer services company did for you. And we're gonna, this doesn't, this isn't the payment of that necessarily. This is just showing that, hey, you owe us this money. Later when we make the payment, we'll credit our cash. But in this instance, which happened on the 12th, we're going to have, let's look at our chart of accounts. So they fixed our computer. So we're going to go, let's go with repair expense. And it was for $458. And like I said, we're not going to, this is just representative of us getting the invoice in the mail, getting the bill in the mail, and booking in the fact that we did incur this expense because we had this repair work done. We owe this money, but we have not yet, cut those checks to pay that yet. Okay, that was $458. Number 9, we received and deposited a $9,300 check from Whitmire Ford. So that, goes back to this one here. But now we've received that payment on the 15th. So now we're going to debit our cash to increase our cash. And we're going to credit our accounts receivable for the $9,300 to represent that we received that cash payment for the work that we did. Okay, so let's keep looking here. That was number 9. Here we are, number 10. So we've got a message here. It's a please issue check 5350 to pay Smith Company $815, and check 5351 to pay Doug's Printing Shop. And both these invoices were entered as accounts payable in January. So again, $815 and $1450. You can see that's basically these two right here. So it's not an expense this period because it was incurred and recorded as an expense before February, and that's why we see it in the ending balance of January on the AP schedule. So with that said, we don't debit expense in this journal entry, but instead we want to debit accounts payable so that we reduce our payable balance because it's we're paying these off. It's those liabilities are gone. It's the 18th. And that was a total of $8.15 and $14.50. Oh, wait, sorry. $8.15 plus $14.50. So again, a combination of those two reductions. And we're going to reduce our cash. Credit our cash account accordingly to reduce that asset balance to represent the payment. Okay, and memo number 11. During the second and third weeks of February, legal services were provided for $7,200 and $4,345. So $7,200, $4,345. So that's going to be the same. I'm just going to copy this down. It's the same accounts and paste those in. Plus 7,200 plus 43.45. That's what it said. Yeah. And one little thing to note. Sometimes you'll see maybe me or if you see other people using plus instead of equals for a formula, it basically does the same thing in Excel. The plus sign is right there on the 10 key little section of a keyboard or a 10 key. And so it's kind of easier to just pop that in and go from there. But remember, we performed this work in this period. So because we earned it in February, we want to record the revenue in February. So we got that. We didn't receive the cash yet. So we're going to book a receivable to indicate that we will receive the cash at a future point. Okay, we're getting close now. What do we got here? Number 12, we issued check to Office Max for $1,180. And I think that was where was that one? $1,180. $22,535. Oh, is it no, it's Dell computer. Huh. Okay, so I guess we're just paying. So we had purchased from Office Max $1,360. $22,535 was the invoice. So we're basically just paying a portion of what we purchased. So it was $1,360 that we owed them, and we're paying $1,180. So not sure why we're not paying the full amount off, but okie dokie. Okay, so we're going to be. Oh, I don't need to book it. Put a date on that one. That was the 20th. And this is on the 24th. So accounts payable is going to be debited or decreased. We're going to decrease the liability there. Cash will also be decreased. And that was for $1,180. Okay, now let's look at number 13. Received and deposited a check from Lee Labs for $43.45. Okay, so now we're going to receive the cash related to a portion of this, this piece of that receipt. And the date was also the 24th. $43.45. And that's going to be an increase in cash and a decrease in accounts receivable. These are both asset accounts. One's going up, one's going down. Okay, number 14. Please note that I wrote a personal check for $9,500 treat this as an owner draw. So this is the owner John Jones taking the money out of the business, paying himself basically, right? So we're going to record a reduction in cash as the business's cash is reduced, and just make sure I get the right drawing Jones. So that, do that, and paste this in. And that happened on the 25th. So the business's cash is being reduced, and the draws account, is being equity is being reduced essentially through hitting this draws account drawing. Okay, just a few more transactions here. On the 15th, we've got a note here saying, please issue checks 5354 to yourself. So this is your own salary being paid, $4,200. Another check to Mark Smith, legal secretary, for $3,400. And I think we talked a little bit about this in class. We'll look at it briefly, and you'll look at it in more detail in accounting too if you take that, where you've got payroll taxes and a whole other variety of things associated with payroll. But for simplicity, we're just going to debit wage and salary expense and credit cash. So move the chart of accounts, make sure that's wage and salary expense. So we're going to record our expense for $7,600, and we're just going to record cash for the other piece. So I'm just copying and pasting that. So reduce cash and record the expense, and that happened on 27th. Okay, and then let's see what's next. Okay, then we got a bill here for $150. Let's just look on our chart of accounts, telephone expense. And this is us just getting this bill in the mail, right? So it's accounts payable. It's not cash being paid yet. That was $150. And that was on, what's the date on that one? I guess we're saying that, February 20th. Okay, 2/20. Well, okay, two more entries, two more memos. Okay, so then we got a bill for $352 for postage meter. So postage here for $352. Let's just look what we got. Postage expense. And again, these are just bills we're getting in the mail, basically, and invoices received. And it was for $352. And then the final one here is, what is this? Looks like electric bill, and probably, let's see what we got. Okay, utilities expense, yeah. And same thing. All these are just monthly bills, and they're all, so what was the total there? That was $134. Seems like an unrealistic utility bill in this day and age. So again, these might all be on the 28th. Yeah, we all got all those. They're all the same date. Just copy and paste. Okay. So then, yeah, just to kind of reiterate, we're since we incurred these expenses are all for usage of services or utilities, etc. in February. We want to make sure the expense goes in February. We haven't paid these yet, so we're going to book a liability, accounts payable, to represent the fact that we are going to pay those in the future. And then when we do pay them, then we'll reduce the accounts payable and change, by reducing cash essentially at that point. So, yeah, okay, great. That's all the journal entries essentially. Don't forget. I mean, I didn't put in the explanations under each one of these, and we can skip that for this project. But do remember that that is a part of normal journal entries, is having the explanations included there. But for now, I'm really just mostly focused most heavily on making sure you get the debits and credits right. So, okay, that portion is all right. So let's take a look at our checklist just to get ourselves on the right path. So we finished all of our journal entries for the memos 1 through 18. Step 2 is to write the account numbers on each account in the general ledger. So we already have the names on there. I think I'm going to skip that step. You guys can skip that step too. It's for the project here. It's a little bit tedious to go through, and maybe I'll do the first couple just to show you what we're talking about there, so you understand. But the point there would be, say, cash is account number 110, and so in the ledger, somewhere here, I would just put it as a dash, and then that would be cash. One, it would have 110 as the number, or maybe over here would make more sense, I guess. An accounts receivable then would be 115. And so on. So in a typical system like QuickBooks or something, this all happens behind the scenes. I mean, you do have to, the very first time you set up your chart of accounts, or if you change or something, you do have to provide account numbers, or QuickBooks, for example, will give you kind of a standardized listing, which you could modify, but it'll give you a standardized chart of accounts to start with. I'm not going to go through and label each one of those. It's a little bit tedious if you guys. I'll leave that up to you all to go through and finish. But let's look at the meat here of the checklist and the next steps. So really what I'm going to do with you guys in the video, follow along here, is just posting our beginning balances, and then posting all of the activity that we have from from the journal entries into the general ledger, because that's the most important thing I really want you to take away from this, is just how the ledgers work, essentially. Okay, so, and I'm going to show you a couple little Excel tricks along the way, I think, too. So Okay, so we have our general ledger, right? We have our cash. We have all of our accounts represented throughout this, just like they're here in the chart of accounts. We have accounts for each of those. We have ledgers for each of those accounts. And so what we need to do is posting our journal entries to our ledgers. And how we do that, is we're going to go back and look at each one of our journal entries and essentially transpose those, or bring those from the journal entry onto the ledger, which is kind of similar. Like, if you remember, we did the T accounts. It's kind of like putting them, remember, on the T account for cash, you'll see all the transactions, and we've talked about this in class, ledgers versus T accounts, but similar kind of a thing. But step 1 is to post the beginning balances. And so what I'm doing this, when I'm going through here and adding these, I'm going to link to those other tabs, because these numbers are already in Excel, in the spreadsheet here, in different places, whether that's in the journal entry we wrote, or the beginning balance, trial balance figures from the prior month. And so instead of looking at this and saying, oh, cash had 10,000, and so I'm going to type in 10,000, which is fine, but I think it's a more efficient use of Excel to just link it. And so to link these, or to do a formula to grab it, in other words, I'm just going to put the equal sign. I'm going to go here. I'm going to click on my beginning balance and just click enter, and then it's just going to pull that in. And remember, what we're doing here is the January closed trial balance, the ending balance of January, becomes the beginning balance of February, just as the accounting information rolls forward every month. So and then, like I said, the easier way to do this is just to use a formula. So let's do that again for accounts receivable. $15.50. Let's do that again for prepaid insurance. Oh, we didn't have any prepaid insurance to start, so there's nothing there. We did have office supplies and office equipment, so let's look for those. Oh, and I'm kind of doing this goofy. Let me do that again. Let's put our beginning balances in. No. Here, sorry. Here's what we want to do to represent, because that matches up kind of how the book shows it. So we're going to just put debit in here to represent that this beginning balance is it's a debit balance, which is as the normal balance. You should always see for assets, it should always be a debit. For liabilities, you should see credit, and equity as a credit. Normal balance, that's the positive balance, the normal balance. So let's do it that way. Okay, so office supplies, I believe we had 400. And we've got office equipment. Okay. Did we have any depreciation? We did. We had some depreciations at $24.50. This is kind of unique because remember, contra asset, that kind of contradicts what I just said, about the assets. But a contra asset will always have a credit normal balance as it offsets the asset balance. Okay, and let's see. Okay, that was the cumulative depreciation. So I just want to make sure we get all of our beginning balances in here. $24.50. I mean, 7,000. Okay, office furniture, 12,500. And that is a debit balance. And then we've got accumulated depreciation on that office furniture of $44.50. That's a credit balance. And then for AP, we've got $47.50. And again, a normal balance for a liability is a credit. And then we've got capital. And that's a normal credit balance as well. Okay. And then, everything else as far as like the draws and the income statement accounts, as income and expenses and everything, those remember, and we'll see this as we go through the problem, those all get closed, down into capital or equity essentially, right? At the end of the month. And that's what we'll do with our closing entry to kind of smash that all down into one number. So we end up at the end of the month just with the closed trial balance that shows just assets, liabilities, and the total for equity. Just like we saw here, how this is rolling forward, we're going to end up with something similar, a closed trial balance. Once we're finished with this whole project, that will have all of the income statement accounts, revenues, expenses. I don't think there's any contributions, investments into the business in this problem, but it would, if there were, it would include those, and then also draws, which we did have, although the sum of all that activity will get closed down into equity or capital. Okay, so that part of the checklist step is done. All of our beginning balances are now shown there. And our next step will be to post the transactions. So we're going to be taking these journal entries and bringing that, taking the information that we recorded here and bringing that into our general ledger. Okay, so what we need to do then is to look, and I'm going to do one little trick here that hopefully won't make this too small, but I'm going to hold the Windows button, and then with my little arrows, the up, down, left, right arrows, just that move, move your cursor around. If you hold the window key and you click to the left, it will kind of scrunch all your stuff over a little bit. And then you can, shoot. Never mind. I'm not going to do that because with my video recording software, it doesn't show up right. Okay, sorry, never mind. But that is a little trick to learn. If you ever want to have two things on one screen like that, two spreadsheets, you can click the window button left when you select one window, and it'll go there, and then select another window, Windows right, and you'll have them both kind of spread side by side in one screen. So anyway, but when I'm recording, it doesn't really work very well. So let's look at our first journal entry. So office equipment going up and cash going down. So we're going to debit our office equipment. Or, since we're already here, let's just credit our. So again, I'm going to be doing, I use plus or equals, same thing. So we're going to go to our journal. I'm just going to do this so that it's all linked. And the only thing I'm really going to do here is just to bring over, we want to make sure we put the date in here to match up. So now we can do the same thing too. You can just link to that cell with the date in it and hit enter. So linking things like that, or having formulas that reference to different cells is a lot easier than retyping everything. Okay, so that was cash being credited, and then the other side of that journal entry was office equipment being debited. So let's go to our office equipment account, and let's get in here and record our debit, and we can record our date. And while we are here, I'm going to set up the formulas to make this ledger account kind of flow correctly. So what you want to see in a ledger is that, for something that has a debit balance, when you have a credit, it reduces the debit balance. If you have a debit, that adds into an asset, for example, you debit an asset, it increases. So here's a formula that you guys can copy here to represent the activity. And that is going to, equal. So what we want to do is we're going to put the equal sign in and then select our beginning balance. So essentially what we're saying is take the cell above it, which is, the beginning balance here, add in a debit. So then click that cell. And then and in this instance, there's nothing in that cell, so it's just going to be zero, it won't make any difference. But then we want to subtract if it's a credit. So this cell plus this debit minus the credit. So here you can see, because there's 4,500, that took the 10,000 plus zero, so no impact, minus 4,500 to give us a $5,500 balance. And that's just a formula that's going to continue. So here's the next. Okay, so that's step one. So we have this formula, and then you can see my cursor here. When you hover over the bottom right corner of the cell, it turns like a black cross kind of thing, and you can then left click and drag down. And so what you're doing when you drag down is you're basically copying this formula down. So you can see in the formula bar up here, as I go through it, it's just taking that same formula. And so as we go forward, say, and we'll put the actual numbers in as we go, but just for just to kind of provide an illustration of how this works, because we have that formula now, whenever we put a number into either the debit or the credit, then this formula just takes into account whatever we have here and updates accordingly. So we don't have to manually recalculate the totals every time. So pretty cool. And then, okay, so that's kind of step one. Let's do that again. So I'll just do it here for each one of the accounts. So we've got, equals our beginning balance plus a debit minus a credit. There's nothing here yet, so it's not going to change anything, but I wanted to set these formulas up and then hover over the bottom right corner there and then drag that down. And one little trick off of that then, so just to save a little time, we can Control C or copy or here, I'll right click and copy, and then we can paste. Let's just do it for now where there are amounts, or sorry, beginning balances, and then we can just paste. So, and that'll paste in our formula there, so we don't have to rewrite it every time. And then hover over, drag down, again, copy, paste. So here's our formula there. We can see we had 7,000. That journal entry that we just booked, or we posted to the ledger, increased our office equipment balance here by 4,500. So we started with 7,000 plus 4,500 gives us 11,500. And the one thing we want to watch out for, so I'm going to redo these ones, is that accumulated depreciation is a contra asset account. So this is a credit balance. So we don't want to add a debit. If it's a credit balance, then a debit is going to reduce it. So we're going to minus this plus this cell, the credit, plus the credit. So it's a little, so if you have a contra account or any account that has a normal credit balance, any liability or equity account, you have to just be a little bit careful when you're doing that formula, because it's a little different from the asset account, right? Because of the fact that you've got debit normal balance versus credit. But, a minor change to the formula makes it work, makes it better. Okay. And so, but we can copy and paste into our office furniture account. You know what? Hey, I'm just going to do it on all these. I'm going to skip there's no beginning balance for prepaid insurance, but I'm just going to put that in. It would be nice just to have all of the ledger formulas in here. Again, accumulated depreciation, contra assets. So I'm going to copy from the other accumulated depreciation account, and be careful not to copy right from the asset account, because it has again, remember, debit plus debit minus credit. But for something with a credit normal balance, it's going to be credit plus credit minus debit. So just a little different. And we can use that for all the all the liability accounts. So we'll go ahead and copy and paste that, drag it down. And just to kind of illustrate what I mean, I think you guys get the point. But since a liability is reduced with a debit as opposed to an asset, if we put 1,000 in here just for illustration purposes, you can see that that immediately that formula picks up that 1,000 and reduces it. And then whereas if we were to put 1,000 into the credit spot, then it would increase it. And it just, has this running total that goes through because we've copied that whole formula down. Okay, so again, I'm going to copy that formula, paste it in. Capital, remember, equity has the same basic formula that, a liability would have. And there's nothing in these, in the draws account or in the expense or revenue accounts yet. And you want to be a little careful, right? So we're now talking about different income state accounts, basically, right? Income statement. So remember your debits and credits. You got to be careful, with make sure you don't do the formula wrong. But expenses are increased with debits. And if you had to, for some reason, to decrease or an expense, if you're backing out something or, backing out a transaction or making a correction, it would be a credit to reduce the expense, and just the opposite. So I'm going to copy this and just go through and put these in. And, there's one thing that's a little different, I guess, on the expense side. We could deal with that. There's no beginning balance for income statement accounts. So I could have just pasted this into the top line, but I think I'm just going to leave that formula the way it is. And when we record any of these transactions, we'll just put our entries on this line immediately. And that will just pick up nothing, right? There's nothing above it. So that's fine. And then if we put a debit for an expense account transaction, it'll just pull that over. And if it was $1,500, it would just pull that over, right? The formula will still work. Okay, so I'm going to go through all of our expense accounts and paste these all in. Oh, I gotta be careful here. I think I messed that one up. So revenues are different than expenses, right? The opposite. So revenues have a credit normal balance, so they're increased with a credit and decreased with a debit. So be careful on your formulas there. Make sure you have those right. So we're saying increase with a debit as the plus minus. Okay. And another expense account. And another expense account. And yet again, more expense accounts. And more and more. So I'm just copying and pasting this formula for all the expense account running totals. Quite a few. If you were using a software, like a QuickBooks or something, this just all happens automatically too. So we're kind of building our own, QuickBooks or our own accounting, our ledger. We're building it in the spreadsheet, which is really what a lot of those softwares just kind of do in the system. But we can do it ourselves. And then finally, we have another revenue account. So be careful not to copy the same formula as an expense account, because remember, one more time, expenses increase with a debit, revenue increases with a credit. So the plus and the minus are different there, right? Okie dokie. So we're mostly all, this border got funny looking there, just fixing that. Okay, so now we've got formulas everywhere in our ledger. And then as we go through and we paste in our activity, or we link our activity, I guess I should say, like for example, this first journal entry that we did, 4,500, it's going to automatically update that running balance every time we do that. We don't have to manually type those in, essentially. So okay, now that we have our ledger formulas all set up to capture the effect of the running totals, etc., let's finish going through and posting each one of the journals to the ledger. All right, as I mentioned, let's go through journal by journal and post our journal entries to the ledger. So we already did the first one. The next is going to be prepaid insurance and cash. And so like I mentioned, we're just going to do a formula for each one of those. So crediting cash there, and let's also do our formula to link to the date. And so as you can see, you guys probably maybe saw that, that just automatically updates due to the fact that we have this formula in each time. It's saying take what the balance was before. If it's a debit, increase it. If it's a credit, decrease. And yeah, so that was crediting cash, and I believe it was prepaid insurance was our increase. And so let's link to the increase in prepaid, the debit to prepaid insurance. So as you can see, that goes up. Link in our date. Okay. And then we had an increase in cash, so a debit in cash. So now you can kind of see that formula, increasing. Again, I'm just going to link through all of these. And the credit was accounts receivable. Oh, shoot, I'm a dummy. That's not prepaid insurance. Sorry, that was supposed to go here. You guys probably saw me messing that up as I was saying it. So debiting prepaid insurance. I was hitting the accounts receivable ledger there. On a second, okay. Righty, and then so anyway, for the third journal entry, we had accounts receivable go down by 5,500 on the 3rd of February. So you guys are watching, you see how that goes. It just takes it down by 5,500 automatically. Pretty cool. That's really the power of Excel, is the formulas and setting these things up to automate as much as you can. Okay, so let's keep going. So that was the third. Let's go to the fourth. So we're going to debit office supplies and credit accounts payable. That was on the fourth. Oh, I went too far. I need accounts payable. Here we are. And remember, it's so we're crediting accounts payable, and since remember, I mean, the way we set up our formulas is that the accounts payable then increases with a credit as opposed to an asset increasing with a debit. Okie doke. So that was our accounts payable entry. Office supplies. Okay, then we have rent expense and cash on the 6th. So now we're going to reduce our cash. We're going to credit cash. And we're going to record rent expense. $1,800. That was the 6th. I think I forgot to put that there. Yep. Okay, rent expense. Then we've got an increase in cash in the next journal entry. Just put the date in first there. And then we debited cash for $3,700. And what did we do? We reduced accounts receivable for $3,700. Again, that was on the 6th as well. Okay. We're on numbers. Journal entry 7. Okay, then accounts receivable went up, and legal revenue. We recorded revenue and accounts receivable. So our AR is going to go up this time. I'll just link to the date first. And just you guys didn't notice or were wondering, so after you do any formula, you just click enter to finish the formula basically. So if I'm just, I guess, yeah, maybe that's a point to make, is I'm going plus, or you can use equals, and then I'm clicking through to the other tab for accounts receivable, clicking on that cell, left click on the mouse, and then enter finalizes your formula basically. And to show you, and so you can see in any one of these formulas it'll say general journal, so that in the quotes or whatever, it highlight the apostrophes, it highlights to this tab, and it says E27. And so as you can see, that's E27, the cell 27 rows down, and that many, it's column E. So anyway, that's how you kind of read a formula. So so 21,000 on the 9th, and then the revenue, we need to record legal revenue. Again, crediting revenue is an increase. So then we've got the 21,000 there. Let's copy our link to our date. Okay, next one, AP and repair expense on the 12th. Oh, here we are. So we're going to debit is an increase to an expense. So we're going to link in there. And we're going to go find, too far. Accounts payable increase, 458. And that was the 12th. Alrighty, and then we're on to number 9. So cash and accounts receivable. So cash going up, accounts receivable going down. It's on the 15th. Cash is going to be going up, so a debit to cash. Debit to cash. And to accounts receivable. To the date. There we go. Okay, and then we paid some of the accounts accounts payable. So now some of the payments are actually being made. So here we go. Cash being credited for $22.65, and that's going to be on the 18th. And then we're going to debit accounts payable to decrease it. $22.65. And that's on the 18th. Okay. And then what's next? Okay. On the 20th, we recorded some revenue and accounts receivable. So AR is going to go up by 11,545. And then we're going to record legal revenue. And link to the date. So as you can see, doing this kind of manual posting, it's not like the most tedious. I mean, imagine doing this all by hand. That would be much more tedious. So Excel is a huge breakthrough, in that regard. But imagine when you're using like a QuickBooks, for example, the instant that you put this information in, QuickBooks would just know, or any other accounting software would just know. It just, it automatically updates the ledgers for these amounts. So you don't have to like link all this stuff and do all this extra work in a modern accounting software. So that's kind of nice. Okay. Sorry. Got off track there a little bit. Okay, that was the 11,545. That's where we ended. Okay. Number 12, accounts payable is going to go down, and cash is going to go down. So we're making a payment for an amount that we owe. And so let's go to our accounts payable account, and let's reduce that with a debit for 1180. Let's link in their date. And let's go to cash. We're going to credit that cash for 1180 to reduce it as well. And that was February 24th. Okay, the next is an increase in cash. $345, also on the 24th. And a reduction in AR, or accounts receivable, because we collected the cash, right? The receivable is a representative of something that we're going to receive, but we have now received it, so we want to clear that out. So cash goes up, AR goes down. Okay, 43.45. Then we got draws. So cash will be going down from the business. Remember, it's basically like being just the owner taking that money out. And let's find our draws account here. We're going to debit that to show a reduction in equity. 25th. Okay, getting close. Just a few more transactions here. Wage and salary expense, and that was cash. We're gonna credit cash for our salaries we paid. And then we're gonna debit the related expense account to show an increase in expenses that we incurred. on the 27th on telephone expense for 150 on the 28th. I'm just going to go through and do all the expenses here because they're right next to each other. I don't have to scroll back up and down to the cash account, or sorry, the accounts payable account. Excuse me. And then, but make sure we do need to make sure that we go back up and record those, and we're not doing just the one part of the journal entry. But trying to be efficient with my. Well, it's funny. That one was just like a bold font for some reason. That's bold there too. Okay, so now we need to record the other side of those three entries, the 150, 352, and the other side, I think each one of those is accounts payable. So let's go to that, and then we'll be in a good spot. And these are increases to accounts payable for each one. Okay, so then we copied all those in, and each one of those has the same date. Just paste that in. Whew. All right, cool. And we've posted all of our journal entries into the ledger. Great. Yeah, cool. One thing we can do that I think I'm gonna do right now. Do I want to do that now? No, never mind. I'm gonna wait a little bit. I was thinking of a check figure to make sure we didn't miss something, but we will know if we missed something when we get to the end of the work, and if we don't balance at that point, we know that we made a mistake somewhere, right? And you could probably see, one mistake that we could have made just now, which would be very easy to make, is when we're linking things, if you only linked the debit or credit, or you linked the wrong cell or something, it's very possible you could make a mistake through doing that. So anyway, just be careful with that. We'll find out if I missed any when we get a little farther along. So yeah, and we can troubleshoot at that point if we do see any issues. So we've now posted the transaction entries 1 to 18 from the general journal to the general ledger, and we've calculated the balances. That's what our formulas did to calculate the balances, right? And yeah, we're going to be looking pretty good. So let's go. Here's a way we can do our check. And it's not a bad idea to check ourselves as we go, just to make sure we didn't make a mistake. And we're going to need to do what I'm going to show you here in a minute anyway. So we're at the point now, we posted all those journal entries. Now what we want to do is create an unadjusted trial balance, or TB is trial balance. So we have finished posting the journal entries. This might be a slightly out of order on the checklist, but I think it's worthwhile to do right now, just to, like I said, to make sure that we didn't mess something up. It's better to find your mistake earlier than do more work and then you find out if there's a mistake. Checking yourself as you go as much as you can is preferable, so there's less potential spots where a mistake could have happened, and it's easier to find the source of the mistake. So for our unadjusted trial balance, we're going to do a formula. We're going to link back to our ledger now, and we're just going to link into the ending balance for cash and just for everything, right? So cash has a debit balance of $51.60. AR has a $23,750. Let's see, prepaid insurance has $840. And I'm just linking into the final balance in that running total. Office supplies has 1,760 total. Office equipment has 11,500. Now remember, be careful. Remember that a contra account, even though the accumulated depreciation shows up on the balance sheet and it's related to assets, it's a contra asset, so it has a credit balance. Important to remember. And it's got a 2,450. Office furniture, 12,500. Accumulated depreciation, office furniture, 4,450. Okay, and now we're into liabilities. So liabilities have credit balances. So AP has 3,759 right now. Capital. So these are all the components kind of that close down into equity. So specifically equity or capital has a credit normal balance. And we can see that if we go back here anyway. We've got our credit balance here. Draws, reduces capital. So that's got a debit balance there. Oh, and look, I got a negative number, so I must have messed that formula up. Okay, so there's one kind of thing to watch out for is this is what I mentioned, as far as I must have the same formula, for capital and for draws, which draws should reduce the capital, so it needs to be this plus a debit minus the credit. So basically the opposite. I'm going to copy that down. So, okay. Okay, so 9,500. And now and the fact that we did a linking too, initially it was negative here because it's just linked. So when you fix it in one place, that fix is then linked everywhere, and everywhere else, gets fixed that way too. So that's the positive. That's the good part about Excel and doing the formulas, is that if you make a mistake in one spot, but it's all linked, when you fix that mistake, everywhere that was linked to that previously mistaken cell or whatever the problem was will all be fixed all at once. Okay, service revenue. Let's find legal revenue, I believe. Oh, service revenue. Oh, that's funny. I think that must be a typo. That I'm going to change that to legal revenue. Okay. We got expenses here, so that's our debit normal balances. Let's go rent expense. Like that. Repairs expense. Like that. Salaries expense. Yeah, the names are a little bit off, but that's okay. Supplies expense. I'm going to link them in even if they don't have a balance right now as well, because we're going to do some adjusting entries, and those adjusting entries are going to produce a balance in these accounts. And so might as well link them now so that when we do those entries later, that they will just automatically show up in our trial balance there. I think it's telephone, right? Yeah, telephone, postage, utilities expense. Getting close. Bank service fee. So that's going to be an expense as well. We don't have anything there yet. I don't know that we even have a. Oh, no. Yeah, there we go. Okay, good. I was thinking we might not even have a ledger account for that, but good, we did. And then interest revenue. Again, this is a revenue account, so it's going to have a credit normal balance. And again, we don't have anything there now, but we're going to do our bank reconciliation, and that will produce an amount. So you can see here, this total was already set with the sum. So it's a formula that just says take the sum of all of these highlighted cells, and so the total of all those is 75,504. You can see the debits and credits all equal, and so that is confirmation that we put in all of our general ledger activity, posted all of our journal entries to the general ledger correctly. Because a reminder, like, like here, I'll just delete one of these just to show you the worksheets. Now you can see that it doesn't balance anymore. This is not the same between them because we didn't put, one of the debits in or one of the credits, but I just undid. So back that out. So now it's fixed again. We're balancing, and that is a good sign there that we're on the right track. We're doing things right. So perfect. Okay, so the next part, so yeah, it was a little bit out of order. We just kind of completed the unadjusted. We at least linked, the unadjusted trial balance, and so we don't have to do more manual work on the trial balance. It's linked now here. I mean, we're gonna have to do some more stuff on the rest of these columns, but we are ready to do the bank reconciliation and write the appropriate journal entries and post those to the general ledger as well. Okay, so I'm going to go to that step next. All right, so we're going to work on our bank reconciliation at this point and write our journal entries and post those to the ledger, etc. So let's take a look at our bank statement to begin and compare, right? Basically what we're doing here in our bank reconciliation is comparing our cash balance shown per the bank statement and then our cash balance per the books to reconcile those essentially and see what the differences are. Make sure we capture everything correctly. Okay, so here's our bank statement that we had, and we looked at this earlier in the video, and this is going to be something that we utilize here for our bank reconciliation. So let's, again, I'm just linking things through. So I'm just going to link to this. It's the ending balance. And per the bank, we've got a total of $20,003. So you can just kind of show you here, we've got deductions, total additions. So we started with $10,000 and then we added $30,120. We subtracted $20,117. These are all the payments, so we write the journal entries that show, cash being reduced, right? But in reality, there's a timing difference because we have to wait for those checks to get cashed. So that's part of the bank reconciliation, right? So that's what we're going to do in this. And so the 10,000 plus 30,120 minus the deductions leaves us with a balance in our actual bank account at the end of the month of $20,003. The balance per our books. Let's look where I want. Let's go to ledger. Let's go to our cash account, and we're going to say, okay, at the end of at that same point here at the end of the month, we've got 5,160. So obviously a little different. I don't know why that summation doesn't go all the way up. Let me fix that real quick. Okay, and what we're shooting for is to have our reconciled amounts be the same. And when we say reconciled balances, the ending balance in our GL and per our bank doesn't necessarily have to match exactly, as we'll see. I'll show you guys here, because there can be outstanding checks that we've issued that we right when we cut that check, we're going to do that credit to cash on our general ledger. That's this amount. But in reality, we mail that check out and you have to wait until that check clears. And so the balance per the bank might show, you might actually have more cash in your bank account until that check actually clears. So, if you were to go look at you go to the ATM, you look at the balance, oh, I got $20,000, but little do hopefully you do know, this is the point of this exercise in doing a reconciliation, is you would know maybe that you have a $10,000 check that's out there waiting to be cashed. And so you don't really have $20,000, even though that is as of the immediate moment. But once that, vendor or whoever receives that check and goes to the bank and, processes it, your cash balance then goes down to 10,000. So you really want to know how much is in your bank, so you don't bounce your checks or have overdrafts and stuff like that. Okay, so this is our starting point. In the bank, we've got that, and in books, we have that. And so let's look here and see some of the components. I like these bank recs; they're kind of fun, little kind of a puzzle to solve. And so right off the bat, what you'll see in these bank reconciliation problems is if there's activity that has just been something that like the bank charged you a fee or something, the bank doesn't send you a bill in the mail or an invoice like this maybe other vendors do necessarily. Well, they kind of do it, but it's included on your statement. They don't send you a separate invoice for, a service charge, for example. And so you need to look at the bank statement and say, oh, the bank charged us $32. So that's part of why I show less money in my accounting records than I actually have, in the bank, or I show more for a service charge. If the bank charged you a fee and you didn't record that yet because you didn't even know until you started doing your analysis of the bank statement, then that's where one of the reconciling items come from, right? So, so one thing we'll need to do per our books is record. Let's put that in. That's an item that we need to account for. So the bank statement has a $32 service charge, and that's going to be, I'm going to do a negative. And I'll just put the bank service charge. And we will record this into our books here with a journal entry, because that is a fee. They took our cash, our cash just kind of disappeared because they had it to begin with and they just took it from us without us cutting a check, right? That's kind of the difference there. So that's one reconciling item. We've got interest revenue on the bank statement to account for. So while the service charge is a decrease to our cash, the interest revenue, they took money from us for the fee, but they also gave us money back in the form of interest. So that is great. We came out ahead there. So let's record that piece. And we'll call it interest revenue. And then we've got one of the things that we can see here is we have this $7,200 EFT, electronic funds transfer. And that will be that's an electronic receipt. And so when we looked at our memos, there was no mention of, the receipt of we're just learning about this by looking at our bank statement. It doesn't, so you can see here, the book, hey, we received and deposited a check, or he did, for $4,345, right? And so he told you that was a check that we received. And so you have that information through the memos. But with this electronic funds transfer, that went directly to the bank. It bypassed, the owner opening the mail and seeing a check and telling you that whole kind of thing. And so we need to account for that. So we need to record that receipt. And just to kind of tie it all together, that's some portion of the outstanding amounts due. And I wonder if I think so it's 7,200, and right, that's what it said on the bank statement. We received 77,200. And the one thing you hope that you can kind of look back and figure out, like, who paid us. That's one important thing. And so it's a little tricky because it doesn't match exactly up with any one customer's outstanding balance. So some combination, and it probably wouldn't hurt to look and see. So let's just look real quick and show, if we look on our ledger, so our accounts receivables started at 14,050, and then maybe it was one of the receivables. Let's go to our journal. Let's go to our ledger and look anywhere that we increased. Oh, here it is. Okay, so here's the 7,200. So it was one of the increases to receivables that we recorded in our memo, and just to make sure we understand, make sure we've got all the details. So it was Whitmire Ford Legal Services, $7,200. So this electronic funds transfer then is that portion, and we can say was the EFT to record. So we got cash. Like I said, it just bypassed, the owner didn't get a check and tell us about it like he did in those other memos. We just learned about the fact that we received this by looking at our bank statement, right? We learned all this just by looking at the bank statement. That's the only way we know that information. Okie dokie. So the thing we need, okay, so that's pretty much everything I think on here. All the rest of this is just activity that will have been recorded otherwise. So one way to really, what you have to do on this is to look and say, okay, let's go to our cash ledger account, and then let's open our bank statement up here. And so we received 5,500. Okay, so on the bank statement, it shows us getting 5,500, and in our ledger, we show the 5,500. I kind of said that backwards, but on the bank statement, here's an addition of a receipt of 5,500, and then in our ledger, we also recorded. So that's not a reconciling item, right? It's recorded both on the bank statement and the in the ledger. So it's not a reconciling item again. So then we've got 3,700, 9,300, 43.45. So let's just look at our bank statement. So there's the 3,700. I'm just highlighting these as we go too, so that we know because what we're really looking for is something that's not recorded on one or the other sources. And really what it usually is, and like I said earlier, is outstanding checks that are but all these receipts probably are going to be on here. So 9,300, but when we get to the payments, that's where we're going to see the difference. But this is what we're doing. We're trying to find differences and say, why are these numbers different? That is the whole process of the reconciliation. So 43.45. Okay, so those are all accounted for in the ledger. We're going to account for these three. That's what we just included. They are differences as of the immediate moment. They are differences, but we are going to record a journal entry for these, so they will not be differences anymore after booking that journal entry. But for now, they are. So what we need to do is then look at our checks that we issued and see which ones have not yet been cashed, right? Because like I mentioned before, when we cut the check, mail it, we immediately do a journal entry to credit cash and reduce it. But it's really dependent on when the recipient of that check takes it to the bank and processes it, that our actual cash balance will reduce in our bank account versus our just the accounting records, which immediately gets reduces the cash balance. Okay, so with all that, let's look. So with 4,500, I'm just using a little different colors here. So 4,500. Okay, 4,500. Whoops. 840. So again, we're looking for stuff that's missing on one side or the other. $1,800. So I'm just marking off everything that is not a reconciling item, or it's, in other words, it's included in both places. 2265. I think a few of these are combinations, so that might, yeah. Okay, we need to go to the actual journal, because I think that, let's see, 5350, I believe. So I'm looking for anywhere that cash went down, just to see if it was a combination of multiple. That was the draws. Oh shoot. Okay. Oh, here we go. 815 and 1450 equals the 2265. So 815 and 1450. So there's the 815 and the 1450. And let's look at the 9500, because I think that was, okay, so journal F59. F59. All right, let's go back to the memos. I don't think, I must not have put that in the formula there to show. No, that's it. That's draws. Okay. This is 5353. Oh, sorry. Okay, so that's the 9500, and that's the 9500 there, and then let's see what is left over. So 1180. Oh, Ellen's, okay, that's there. And then I think the sum 9865. That was the 1180, right? Okay, 1180 is there. Okay, so now we've gone through and highlighted everything that actually let me 20. I think the 2265. I think is that. Okay, yeah, the sum of those two. Sorry, I didn't highlight that one right away. So you can see down here the sum. The sum of these two individual checks is the 2265, which is shown here. So we'll highlight that one. So the only amount, and this again, this one I should highlight there because that was there. So we've now kind of drilled, combed through the whole thing, and the only difference that there is between the bank statement and the the general ledger for cash when it comes to the checks issued is this $7,600 check, and I gotta remember what that was for. Oh, okay, that was our salaries and wage expense, which makes sense, right? So at the end of the month, you're almost like the day before the last day, you write this check. So there's always this timing difference, right? And a lot of it, because the bank statement usually cuts off at the end of the month. And so a lot of times you'll have these outstanding checks essentially. So you've issued this check, you wrote the check, you sent it, gave it to your employees. This was a salary expense check. But the employees, you, the accountant, maybe you would know this too, because it was supposed to be like you are the accountant paying yourself kind of in this instance. But you haven't gone to the bank yet to cash the check. But in the ledger, like I've said multiple times, right when you cut that check and give it out, all that, it goes to cash right away. So it reduces cash right away. So what that means is that in the balance per the books, there's a minus. There's this check, outstanding check. I'll call it OS checks. And that was 5354 and 5355, right? So 4,200 and 3,400 combined to make 7,600. And I'm going to say 53.54 and 53.55. So now we know. Honestly, you know what? I'm going to do it like this. This is probably a little, just to illustrate some good habits, because these are individual checks that, you know, in the real world you'd be waiting to see when these go through, and so you really want to see them individually. It makes it easier to analyze. So it was the 53.54 check was 4,200 and the 53.55 check was 3,400 to sum up to the 7,600. But doing it individually, like in the real world, when you get your next bank statement, you could look at it, because say, for example, these two checks, maybe somebody lost one of them, you know, or for whatever reason they didn't cash it. Could be another month goes by and you're like, oh, I still have this amount outstanding. And because you have better records, you know, it's easier to see which one it is. You can look back and say, oh, let me look at my records. Oh, check 53.55 was issued for this reason to this vendor, this employee. And then you can reach out to that employee and say, hey, why haven't you cashed your thing? Did you lose it? Did you lose the check? And you could reissue. You could do a stop payment on that check and reissue a new check. So, all right. And then we have succeeded. So our reconciled balances are now equal, right? So the cash in the bank at the given point at the end of the month is not necessarily equal to the balance for books, but we know because of those outstanding checks, basically, and because we just haven't done this journal entry yet to record this activity, but we know all the components of the differences and we understand them, etc. So that's the point. Okay. So final step then in this part of the process, like I mentioned, is to record this activity that we learned of, basically, you know, not through the memos, but by looking at our bank statement. But it still happened during the month, right? We need to record that. So we're going to go in here and we're going to go back to our general journal now. And we've got a section specifically here for bank reconciliation entries. This will be like on the last day of the month for each one of these three. And so the activity we were going to record is the service charge. It's indented over there. But it's the service charge, the interest revenue, and this receipt of cash, right? It's electronic funds transfer. And remember, I was Whitmire Ford. We originally recorded that as an AR for 7,200. It's a component of one of these entries. So as far as journal entry goes, then we received cash. I'll do that. The first one that I just talked about was the receipt of a receivable from Whitmire Ford. And that was the 7,200. So our balance in cash goes up. And then we had cash go up again, and that was interest revenue. Again, I'm going to do it like that. Just link to it. Okay, and then finally we had cash go down, and we're going to say, let me look at the chart of accounts and see what is here. Oh yeah, okay, bank service expense. So that's the account that we want to use there. And in this instance, cash is going down because the bank is taking our money basically out of our checking account for their service fee. And I'm going to make that a negative link. It's negative on our bank graph. I'm just linking to this, but you know, it's a debit. You don't ever have negatives shown here. Just remember debits and credits, right? Okay, so now we've recorded, we finished our bank reconciliation. We know what the differences are. We booked these entries. We know there's 2 outstanding checks, for these amounts that we're waiting to cash. And that's really the only residual difference at this point. And because we linked everything, we go to our worksheet, and now, why didn't that work? Oh, sorry. One more step. But now, all right. So this is the next. We forgot. We gotta post our. We did the journal entries. Now we got to kind of do that same process again, right? So we have to put those journal entries into our ledger, and then they will flow through correctly. So we had 2 journal entries with cash increases, and we have 1 journal entry with a cash decrease, and then this was a reduction in accounts receivable from that Whitmire Ford credit there. And we had the other 2 are the bank service charge and interest revenue. So interest revenue was a credit to interest revenue to record that as an increase. And finally, the expense. So we're going to debit the expense for $32 for the bank service charge. Okay, now when we go to our worksheet, we should see some change. This is still balanced because of debits and credits should always, we always have those equaling. But our final ending cash balance is $12,403. We have our interest and our bank service fee recorded, etc. And that's we basically finished this section. Both of these, we've completed the unadjusted trial balance. We've prepared the bank rec. We posted all of our journal entries. Yada yada yada. We've done everything basically up to this point. And so the final things that we need to do after this point is we need to do our adjusting entries and post those again into the journal and put them on the worksheet too here that we're just looking at. Journalize them and then post those journals to the general ledger. And then we're going to take all that, prepare financial statements, do a closing entry, and then we will be finished. So we're getting close. A few more steps. Thanks for following. All right, so we're getting close to the end of our project here. And at this point, what we need to do is to record our adjusting journal entries. And, you can see we've got everything here in our unadjusted trial balance. So then we're going to post our adjustments and go from there. Okay, so let's look at this adjusting journal entry information. And we'll kind of, I'm just going to do it off to the side here. We'll sort of make some notes and some calculations for our adjustments. So the $7,000 of office equipment purchased prior to February has a 4-year life and $1,000 residual value. So if we look at let's go to our ledger. So this was office equipment. Here we go. So you can see it had a starting balance of $7,000, and then that was our first memo entry, was to purchase a computer and a printer, I believe, for $4,500. And so now what's in our balance for office equipment is $11,500, and that represents kind of multiple things essentially. So what we want to look at here, I'm going to say 7,000, and this is our purchase price prior to February. It has a 4-year life, so I'm going to do just doing kind of our general depreciation calculation here. So we take our purchase price minus residual value. And then we divide it, so it's going to be, I'm going to do it by month too. So 4 years, I'm going to say 4 times 12 is 48 months. And we'll say useful life months. And then we'll divide that, the purchase price minus residual value divided by the useful life tells us that it's $125 of depreciation expense per month for that piece of equipment. And I'm just going to copy this because this little formula is handy. And then we can say the computer and printer purchased on day 1 of the month that was $4,500. It has a 5-year life, so I'm going to change the 4 to a 5. It's 60 months. And it has a $300 salvage value. And so that calculates out to be $70 per month of depreciation expense. Okie dokie. And that basically let's see if there's anything else I'm missing on this one. And okay, and then we've got one more kind of component here. Office furniture. So one thing we can kind of look at is we'll say, and this is going to be depreciation expense total. So both of the ones both of the items that are noted in number 1 are office equipment. So we can make one journal entry to just that one expense account for office equipment specifically. So I'm going to add these together to say in total we're going to be looking for $195. We're going to post $195 of office equipment related depreciation expense into one line item for that, even though it's 2 separate pieces of equipment, or 3 I guess with the computer and printer, etc. But we can just put that into one expense account there. Now alternatively, I'm going to do this. So then number 2 here, whoop, that doesn't look good. I'll just, okay. So then that's this is office equipment, and this is office furniture. Both depreciation, but just different accounts that we're using for these because they're different things essentially. So I'm going to zero this stuff out. But it says, so the $12,500 of office furniture purchased prior to February has a 7-year life. Okay, so let's change the 5 to a 7. So 7 times 12 is 84 months. And it has a $500 residual value or salvage value. And that gives us $143 of depreciation expense each month for the office furniture. Okay, so we've got those 2 components to record. And then we've got 2 other items to look at. We'll say at the end of February, there were $330 of office supplies left. So if we look back at our office supplies account, we had $400, to start as a beginning balance. We bought $1,360. That got us to $1,760. But then when we went and counted, we saw, there's only 330 left. So the difference between those 2 numbers, this is just what you had to start with, what you purchased. You aren't tracking the usage every single day kind of a thing, but you go into account at the end of the month. Oh, there's only 330 left. That has to mean that $1,430 was used up essentially. So that'll be office supplies used during February. And we're going to need to reduce this balance to reflect what's actually on hand. We did our account. Reduce that, and that's the difference there, basically. So that is that piece. And at the end of February, 1 month's insurance has expired. And so remember, we've got our prepaid insurance here that we purchased $840 of prepaid insurance, and that was for 12 months. And so if we have that 840, or let's just equal, let's take our, so per month, if we divide by 12, we'll have $70 per month of insurance expense. So this represents 12 months, and we're going to want to reduce that down by 1 month of usage to leave us with 11 months of residual prepaid insurance, 11 more months that we have of coverage on that insurance policy, essentially. So so this is all the information that we need to know to book our adjusting entries. So then let's go to our journal, and we have kind of a specific location here for the adjusting journal entries, which is helpful. So again, we're going to just book these in. We're going to put the end of the month for each one of these, because it's not like it happened. You're doing all this work at the end of the month, essentially, I'll say. And let's look at our chart of accounts. So we've got depreciation expense for equipment and furniture. And yeah, so one thing that's kind of funny, actually, I'm looking at this. We're going to need to add one more line here. So if you want to do this with me here, so what I'm going to do to add a row, I'm going to copy this and add another row. Actually, I'm going to add 2 more. I'll just add 1. Yeah, I'll just add 1. Okay, so right click, copy, and then right click, insert copied cells. So that just pushes it down. It adds another row, and that's all good. Okay, and so for this journal entry, what we want to do is, like I said, we've got kind of a couple different things going on here. We've got depreciation expense for equipment and depreciation expense for furniture, and then we also have accumulated depreciation for each one of those things as well. Different types. You've got the computers and stuff, and that's your office equipment, and then you got the furniture. So let's invent those for our credits. So it's our contra asset accounts, and these are our expense accounts. So remember, expenses increase with a debit, and I'm going to link over to where we did those calculations. So the depreciation expense total for office equipment is $195, and then the depreciation expense for furniture is $143. And then to record that on the other side, we can just copy those over, essentially. So there's our depreciation expense, and we've increased our accumulated depreciation to account for the month of February, essentially. And we got that done. Okay, and then we had office supplies used up, right? So I believe we have an office supplies expense account. I'm just going to link to these from the chart of accounts. Office supplies expense, and so that's an increase, or we are recording the expense of the usage of the office supplies, and then we're going to credit the actual office supplies asset account to reduce it, and that was, I believe, $1,430. And Same there. Okay. And the last adjusting entry then was for insurance expense. So let's see if we've got our insurance. Yep, insurance expense account. And we're not reducing, cash on this one. This is kind of gets back to the whole idea of these adjusting entries. We're reducing our prepaid insurance by 1 month's worth. And so we're going to book that expense. We're going to put that. Yep, $70. So 1 month's usage. And those are our adjusting journal entries. And then again, the same process like we did with the bank recs. We have to post those to the general ledger. So we'll go back to our general ledger here. We'll go down and say, okay, here's our depreciation expense for equipment, 195. Our dates in there. It all has the same. They're all the last day of the month, so that's fine. And then let's find our other depreciation expense account. Oh, do we not? Okay. Oh, we are missing a depreciation expense for the furniture. Okay, I'm just going to copy this in here. Just to get a new, because of goof up on our part of creating that or something. But anyway, we can do it just like that. And then we'll go to the journal entries. And let's go to furniture. Oh, you know what might be a little easier? Yeah, no, let's leave it. Okay, that's fine. So that's that and that's that. Let's make sure we got the 143 and the 195. Okay, and then let's go up to our accumulated depreciation, and that's going to be the credit that we have for these entries. So this is the office furniture piece, and then we need the accumulated depreciation office equipment. Let's go here, office equipment, 195. Okay, we should have both of those recorded now. And then let's look at our other entries, office supplies expense. These are more straightforward because there's only 2 lines in each of these journals. I'm just going to type that in because I know they're all the same date at the end. And then we want to reduce our actual office supplies as well. By 1430. Oh no. Whoa, something got weird there. What happened? Sorry, sometimes when you do different linking to different formulas, you end up with a circular reference. And to solve that problem, I'm just going to paste that number in so it's not a formula anymore. And then it won't give me that error. So let's go back to our office supplies here. We're going to credit our asset account. Clicking through every one, but the one I'm looking for. Oh, shoot. You know what? I just recognized I picked the wrong account. That was supposed to be office supplies, and I put office equipment. So sorry about that. Very different things. Printers and computers versus paper and sticky notes and pens and stuff. Okay, so that's fixed there. And then the final journal adjusting entry and our final journal entry for this whole project is or other than the closing entry, but our insurance expense and prepaid insurance. So let's go up to, we need to reduce our prepaid insurance by, again, Yeah, something with my formulas there's not liking that. So let's copy, let's paste as just a value instead of a formula. And let's try that again. Okay, so we want to credit our prepaid insurance. Okay, that's good. And then we want to record insurance expense. There it is. $70. I don't know why it's bold, but let's take that out. And 2-20. Again, bolding. Weird. Okay, so I think we have all the stuff to kind of wrap this thing up. Yeah, cool. Okay, so here's oh shoot. Oh, you know what? Oh yeah, that one thing I saw right off the bat. Now I'm not balancing, so that's kind of funky. What's going on there? Let's see what the difference is between these two. 143. Uh-oh. I must. Oh, you know what it is? That was part of the depreciation expense. And the funny thing here is that we only have one depreciation expense account here, which is fine. Let's just add both of these depreciation expenses into the one expense account. So equipment and furniture are just going to go together into one to be that. But there's one issue that is a little tricky with all these spreadsheets too. You kind of run into, because what we want to show, we want to show our adjustments a little more clearly. I'm going to hide this part because we're going to do a different income statement, balance sheet presentation. But this is basically now the adjusted trial balance, because the way that we did our links, for example, for office supplies, it's showing 330. And it's a little tricky, but like what we wanted to show was the unadjusted balance first. So what we need to do is actually to link not to the adjusted balance, but to the pre-adjusted balance where it was 1,760. So let's do that real quick. So it's not F43 anymore, but it is going to be, because that was F43 was here, but that's the adjusted, because we post this adjusting entry. We want F40. And then let's see, what was the other ones that we did? The other ones were basically accumulated depreciation. So we're going back to accumulated depreciation, and let's pick up the pre-adjusted balance, if you will. Is that office equipment? Yeah. And then same thing for office furniture. Pick up the pre-adjusted balance. And then I think the other one was prepaid insurance. Let's pick up the pre-adjusted balance, 840. And then again, same thing here. So depreciation expense really would be 0 because we didn't have any before. But let's link to that just to be consistent in our linking. So that's we want the pre-adjusted balances, so before we booked anything there. And I guess it's both those accounts too. There's depreciation expense for furniture and equipment. Okay, and then let's see, what's our final piece here? That was depreciation. Then we have the supplies expense, remember, because we did record that as an adjusting entry. So where's our supplies expense? Office supplies. Okay, so we want the amounts before the adjustments, and then we're gonna show the adjustments and show a final adjusted trial balance here. Is really how it's going to show up. yeah, finally, the other adjusting entry, right, was that insurance expense. So we're gonna show the pre-adjusted balance there, which is 0 because we didn't have any insurance expense reported yet. Okay, so sorry, that was a little bit of a detour here to fit this into this kind of presentation mode with the columns and everything. So now what we want to show is a credit to the prepaid insurance to show it being reduced. So I'm just gonna pick these up off the journal entries. So that was 70, right? And that's a reduction credit there, and a debit to insurance expense. Okay. And then we had office supplies, and it's a reduction of 1,430. And that the other side of that entry is the supplies expense entry of 1,430. And then finally, it is the depreciation entry. So we want to increase our accumulated depreciation for office equipment here. Office equipment by 195. And then we want to increase our accumulated depreciation for office furniture by 143 or 142.86 to be down to that many decimals there. And then both of those, we're just putting both of those into one expense account. So we just add both those together. The sum of those two basically of 338. And yeah, there's our all of our adjustments. And then our adjusted trial balance here, that it's basically, yeah, these we really is just bringing these over, except where you got a debit minus the credit. You got the debit minus the credit. You've got your accumulated depreciation credit balance plus the credit. Oh, I'm putting it in the wrong column though. That should be a credit balance. So those are additive. No adjustments there. But this is a credit plus a credit. AP is a credit. Capital. The rest, a lot of these are just bringing the balances over. These ones, I guess, it's not just bringing it over, but it was 0 to start plus these. Oh, shoot, I'm putting those in the wrong columns too, my bad. Should be debits. So 0 plus the debit balances. And then no other adjustments really otherwise. So, all right, and that's the end of our adjusted. That gets us our adjusted trial balance there. So now we booked our bank recs. We've got our adjustments. We calculated. We booked the journal entries. We put those adjustments into our ledger. So we should basically be very close to finish now. We need to prepare our financial statements and then do our closing entries basically, and we'll be all finished. Okay, so we're going to go into, we've got our worksheet, we've got unadjusted, adjustments, adjusted. And what we want to do now is to prepare our financial statements. So we've got all our numbers basically. Our trial balance is good. Our journal entries are all posted. And we want to record or prepare, I should say, our financial statements. So let's do that now. So we've got, I'm linking all this through. And I'm going to link this into our trial balance. So our service revenue, or our Really, it's legal revenue. Let me change the title on this. Legal revenue. Could be called service revenue, same similar kind of thing, but just for consistency's sake, that's that piece of revenue there. Then we've got a little bit of interest revenue, so that's cool. And then we want to add both those together to get our total revenue. And remember, on our income statement, we're doing revenues minus expenses to get net income. Okay, and then we've got rent expense. We've got repairs expense. We've got salaries expense. We've got supplies expense. We've got insurance expense. We've got depreciation expense. Telephone expense. Postage expense. Utilities. And bank service fee. Okay. And then here's a formula. I'm going to go equals sum of all of these instead of doing plus, 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 plus. Make that a little easier. That gives us $12,364 in expenses, $32,620 in revenues. And then let's do equals revenues minus expenses. So we got net income this month of $20,256. So pretty good. What would that be on an annual basis? We times that by 12. Law firms making $240,000 a year, so that's cool. Okay. So let's take a look here. Oh, these dates are a little funky. Let me fix these. 2-1. Okay. Okay, so our beginning capital. So we want to prepare our that was our income statement, one of the primary financial statements. And now we're going to do our statement of equity, owner's equity. So we're going to have our beginning balance in capital. And we can, for this one, we can link to the beginning, kind of really, the beginning balance here. We're just showing the change, or really the changes in equity over the month, essentially. So we began with equity of $32,300. We had net income of $20,256. Remember, all the revenues and expenses are what changes, equity. We had no contributions. There's no investments into the business, kind of a deal. But there was distributions here, and we had a total of, I'll go to my ledger, distributions or draws in this instance of 9,500. And so the total increase in capital is going to be net income, add contributions, which is none, minus these distributions that we show. So that comes up to $10,756. And that gives us, sorry. I'm just trying to make that a little more consistent. February, I guess, should be 28th, the end of the month. Does that make sense? Oh, geez. Okay, here. Let's just do it like this. That's going to bug me. Just it's different wording, formatting, all that. Okay. So at the beginning of the month, we had $32,300. We had net income, and we had minus some distributions. So the net impact in capital is an increase of $10,756. So we began with the $32,300, add in $10,756. So ending equity, then ending capital in his account is $43,056. And then let's go down to the balance sheet finally and kind of finish this guy out. And we're gonna see here. Okay. So now we're going to link over to we're going to use our trial balance again. So 12,403 for cash, 16,550 for accounts receivable, Prepaid insurance is $770. Office supplies is $330. And then here the way we show these depreciable assets a little differently, just because we have the contra asset of accumulated depreciation. So I'll show you that here. We're gonna do the 11.5, and we're gonna say less the accumulated depreciation of the office equipment. So this minus this minus that is our net book value, and that's kind of the overall balance you'll have there. And then office furniture minus the depreciation we've recorded so far on the office furniture, and that leaves us with $7,907 of net book value. Okay, and then we're going to add all these assets up. I'm just going to go through and summarize all these. Okay, 46,815, and that's our assets. Okay, and let's put our liabilities in here off of our adjusted trial balance. So AP, and then I should say total liabilities. Sorry, here's a typo. And really, that's the only liabilities we have is just the accounts payable, I guess I'm looking at. And yep, that's it. We don't have any, bank notes or anything else like that. So, okay. And then we can just link to our capital account here. So we had, we kind of calculated out what ending capital is, so we can just link to that, 43,056. And now we're at the very end. This is like day one of our accounting class, right? Assets equal liabilities plus equity. So we're going to add our liabilities and our equity together. And then we're going to check ourselves. This is how we did we miss anything? We can say, assets equals, or in other words, you could, if they equal each other, you can subtract them from each other and get 0. And that's what that shows us there as a check figure. And yeah, we are in balance. Assets equal liabilities plus equity. You can see that's the same number. So there you go. There's all of our there's all our financial statements. This is the good stuff that the business owner really going to want to know. And you can, analyze this and take it to a bank to get a loan. Like, there's no loans out right now, but if the business wanted to take a loan out, etc. So awesome. Okay, and then we're pretty close to the end here now. So we've got our income statement. We did those financials. The last part that we got to do is to do our closing entry. And so for our closing entries, what we want to do is we're gonna use the income summary kind of method, if you will, for doing the close. And so, just as a reminder, I will cover this in class. So hopefully, kind of a refresher for everyone. We're gonna book a couple entries here to close all of the revenues, expenses, and draws in this instance, because we don't have any contributions, remember, into capital or equity, to leave us with a trial balance that has it'll only have capital, just like this one does. It'll take all the revenues, expenses, and draws and contributions and combine all that information into the capital. So we have an ending post-close trial balance that just has assets, liabilities, and equity without, showing like the balances and the revenues and expenses. And then that will roll forward to the next month. So the way that we do that is using this concept of the income summary. And so I'm going to link to, so we want to find all of our those accounts that we're closing, if you will. So revenue, and let's do that. Let's do each of these individually. So I'm going to say legal revenue is one of the accounts that we're going to close, and then interest revenue is the other revenue account that we're going to close. And we're going to use, like I said, this thing called the income summary. It's kind of like a transitory account that just shows up to help us close all this stuff out. So what we want to do is we want to zero, we want to clear these out. Move, if you want to think of it kind of like moving the balances into the income summary. So you're remember, so before we close them, legal revenue has a credit balance. So if we want to zero that out and move it into this income summary, which then gets moved into equity, we're going to want to debit that to get it to zero. So we're going to debit for this, just, for its total. Same thing with the interest revenue. We're zero both of those out, and then the income summary will then get credited by the amount, right? We're moving, basically, right? We're moving these into capitals with the whole thing that we're trying to accomplish here. So, okay, so that's the revenue portion of the closing entry. Then so that was the revenues. So then all of these expenses here, they need to be closed out as well. So we need to take those to zero. So they're debit normal balances. So we need to credit those to go to zero. And we're going to debit the income summary in relation to all the expenses, to move all those expenses into the income summary, basically. So the way that probably the easiest to do this, I'm going to do a formula. I'm just going to say equals. Since there's so many accounts, instead of typing them in or whatever, I'm just going to do a formula to link to that and just drag it down, kind of like we did before. Nope, we got revenue, so we don't want that one. We want all of the expenses, essentially. So that's dragging a formula for the names, and I'm going to do a formula for the totals. And my summary down here, 12,363.86. That agrees to the total there. So I've got that's all of the expense accounts. And sorry, I kind of screwed that up. Those, we should be crediting those, right? Because they started as they are prior to them being closed. All the expense accounts have debit balances, but since we're closing them or taking them to zero and transferring their balances essentially into this income summary account, I'm going to do a sum, so equals the sum. I'll show you. So just because there's so many of those, I'm going to go equals the sum and then highlight all the cells. So the total of all those is 12,363. So if we were to, if we want to look at this like as a T account, right? And we say this is the income summary. Get there. Okay, so then what we did was we credited, right? We took all the revenues in there at 32,620. Okay, and then we debited here for the expenses of 12,363.86. And then the final piece is the draws. We didn't have if there was contributions, investments in the business, we would need to close those as well. But there was not. So for the draws, there, what was it, 9,500. And remember that the draws account has a pre-close. We look here, we go to draws. It's got a debit balance, so we're going to need to credit that. And then again, the offset is the income summary. So we're going to debit the income summary and we're going to credit the draws account to reduce it to zero from its closed balance. So it's a debit for 9,500. So we need to credit that for 9,500. And then we're going to debit the income summary for 9,500. Here you can see that, with our little T account, if you will. So we've got, what's this? I'm going to sum these up. And you can see there's a total increase due to the revenues of 32,620, and there's a total decrease to the income summary, or the equity is essentially where this is going to end up at, of 22,136. And taking the difference between those, the bigger minus the smaller, we get 10,483, and that should agree to our let's see if I missed something. It should agree to our change in capital, because that's what's eventually going to get moved over there. So let me see, what did I miss? 1,364.32. Oh, is there 75? So our revenues minus our expenses should be 32,620. Is that what we had? 32,620. Just trying to see if I. What the heck? 12,364. 32,620 minus 12,364. 32,620 minus 12,364 is 20,000. What am I missing here? 32. Huh. Well, oh, wait. Oh, 12,636. Oh, something's funky there. Okay, so we're missing something. As you can see, this number doesn't match our. I think I just typoed that one. Sorry, I typed that in wrong. Sorry, my bad. Whoops. Okay, that happens sometimes too. So anyway, to get back to what the income summary is supposed to represent, then is basically the closing. It's basically representing what's happening on the statement of owner's equity, right? So we had beginning balance, and then the income summary is closing all this stuff into capital to get us to an ending balance there of the 43,056, but doing it through actual, journal entries and whatnot. So the increase in capital then is 10,756, which is what you see here. That's the difference with the draws and the expenses and the revenues and everything. Again, the same thing you see on the statement of owner's equity. But doing it through journal entries to actually close those accounts out and prepare a closed trial balance. So that's that. So the thing, though, the final little step in this, which I need a couple more lines here, so bear with me while I copy and paste these in. So the final piece of our closing entry then becomes to actually close the income summary into capital. And so so as we can see, we've got in the income summary, then we would have credit balance. So we need to then debit the income summary and credit Capital Jones, his equity account. Put that over for the 10,076.14, and then that just moves that 10,756.14 into capital, and that's basically doing the beginning balance plus moving that gives us 43,056, and so that's what you can kind of see here is that when we do this final debit of the 10,756.14, it clears out, the increases and decreases in the income summary are now equal. It's just, like I said, it's a transitory kind of a holding account for all this activity. You sum it all up and then you move it over to capital. So income summary ends up with a zero balance, and the capital account gets adjusted for with to have the increase of the net income and all the rest of it. So, okay, we are very close to being done now. The final steps in all of this, and to kind of show. Let's see. So we got our closing entry, and really, so here's this, and to journal to post the closing journal entry to the ledger, then essentially is to go back there. I'm not going to have you guys actually do this in this one, but what we would be doing, I'll just show you an example of how that would work. Right, we're taking this to zero in the ledger, so we would be debiting the revenue account, like I said, to close it out. So you would get down here, closing entry would be that, right? So everything on the income statement, revenues and expenses, all go to zero. The draws go to zero, and everything below the line here, basically, right? All this stuff that's a component of equity, the balances go to zero, and it gets moved, if you will. They go to zero, and it all moves up into capital. So, we'll do it for the heck of it. So just to give you an idea of exactly what we're doing here. Sorry. So the expenses should all be credits, right, to go to zero. So this is kind of the whole process here. This will sort of mess up our worksheet that we had with the adjustments, because we're linked to some of this stuff. And this all happens behind the scene in accounting software. So it's not something that you would ever have to necessarily, that's revenue. So you'd ever necessarily have to do on your own to actually go through and do all this, zeroing out of closing entries and all that stuff. It all happens automatically, but it is important to know what's happening. Because you want to be able to understand kind of, just all the accounting impacts and everything. So everything, below capital, everything that's a component of capital now would have a zero balance after the closing entries. And then capital would have the difference, which is the difference of all this stuff that we did in the closing entry of the 10,756 to bring it up to 43,056. And then that's where, this obviously it goes all crazy because I did all those closing entries. So don't book those because it messes up the linking. But that's anyway, let's just keep it on this one. But what you want to, the idea is that everything on they call them temporary accounts, the revenues and expenses, draws, everything else, that all goes to zero. I'm actually going to undo right now to not have that show, because I want the linkage to work still for the financial statements and everything else. But I wanted to give you just an explanation so you can kind of see what was happening. So now our financial statements again look good. The linking gets broken if we actually try to post the closing entry stuff into the ledger. So let's not do that. But because what I want is to be able to you guys to turn this in and be able to see all your stuff without it being broken, basically. So cool. But what we want to do then, we do want to create a post-close trial balance here. So we have everything's going to be basically the same, right, on the balance sheet off of our adjusted trial balance. No real difference there. The only thing that's going to change, so I'm just going to go through and put all this in office supplies. $330 office equipment, 500. We've got our I'm getting lost. Okay, too many columns. Office furniture, our accumulated depreciation, our AP, and then everything else, all the rest of this stuff gets combined. That's what our closing entry really did. That income summary kind of just all gets like combined together, and it moves into capital to lead us. And again, like I said, it's really the what's happening here. So beginning capital plus your net income minus your distributions gives us our ending capital, 43,056. And that's what we want for our closed trial balance to show capital is now 43,056. And if we did everything right, summarize here, fingers crossed, woo! Our debits and credits equal. We did it all right. And then that's it. That's basically the whole project. But in the real world, if you got to this point, what you would do with this then is this rolls forward to the next month, March, and you just start all over again, with new transactions being booked in and adjustments and doing all the stuff, and then doing the closing entry at the end, and just keeps repeating itself basically. So awesome. All right. Well, thanks guys. Thanks for following along. I know this is a big project. It kind of pulls together everything that we learned in this class, at least 90%, something like that, of everything we learned in this class into kind of one big case study or whatever. So hopefully you found this walkthrough helpful. I know it's a lot here to work on, and Excel skills and all that kind of stuff, but I think that all of this work is really important, and learning Excel is important. So hopefully you were able to follow along without any significant issues. And if anything came up where you were confused on formulas or anything I was doing or talking about, as always, just reach out to me, and I'm happy to answer questions. So thanks everybody. Take care.